In the last video, I told you what global liquidity is, what will happen to it in the future, and we compared its dynamics with the dynamics of the stock market. Today, I will tell you what Fed liquidity is, what impact it has, and teach you how to use it to determine future market movements. First, we need to understand what a central bank is. A central bank is an institution that controls the monetary base. The monetary base consists of cash and reserves. Underneath the central bank are commercial banks, and they all have correspondent accounts with the central bank. And the funds that lie in these accounts are called reserves. These reserves are needed for banks to be able to pay among themselves, and they are not taken into account when calculating the money supply, because they do not leave the banking system. And besides the central bank and the commercial banks, there is everyone else. So it's people, businesses, and so on. An ordinary person cannot have an account with the central bank, but he can have an account with a commercial bank, and when you deposit money with a commercial bank, you are actually adding to the monetary base because the latter has an account with the central bank. The main task of the central bank is to control the interbank rate, which is set for reserves. Simply put, the task of the central bank is to determine at what percentage bank reserves will be engaged and provided. If, for example, the key rate is at 5%, this means that the central bank will pay 4% for the excess reserves that it has and lend at 6%. When there are few reserves, the rate will rise. Figuratively speaking, the law of supply and demand will work. If there is a shortage for something, then the price will rise. If there are a lot of reserves, the rate will fall. If a private bank needs additional reserves, the central bank will provide them on a collateral basis. That is, a private bank takes reserves, in other words, money, and in return provides some assets, such as bonds or mortgage-backed securities, which they eventually undertake to buy back. If there is too much money in the system, the central bank withdraws it, for example by selling bonds. Once again, since this money does not leave the banking system, it has no effect on the money supply. And you should also realize that we are only talking about the figures in the books. That is not to say that money from some bank in Houston will be traveling by wagons to the central bank and another train full of bonds will be coming to meet it. However, this is where QE comes in. This is a situation when the central bank buys a large amount of assets on its balance sheet. Moreover, it can buy not only from commercial banks, but also from other financial organizations and even from private sellers. If the purchase is made from banks, only the volume of bank liquidity changes. That is, the amount of reserves grows, which means that it exerts downward pressure on the interest rate. If the central bank buys assets from the non-banking sector, then the money supply also increases. But in any case, when the QE program is going on, the reserves of private banks will increase. And you've probably heard that the QE program is one big financial experiment. Because the original idea was that increasing bank reserves would encourage banks to lend more, which in theory was supposed to stimulate the economy. However, as it turned out over time, there was no connection because credit is not limited by reserves. The only thing that reserves can affect is the key rate. That is, if they were insufficient, the rate would rise. And it, in turn, should be controlled by the central bank through the provision of new reserves. And in the ability to create these reserves, or in other words, to print money, the central bank is not limited in principle. That is, simply put, when money is needed, then it can be printed. And there is no point in doing it in advance. But things are a little different when asset purchases are made from the non-banking sector. Imagine you are a financial institution or a cool investor and you get free money. What are you going to do with it? Since there is a lot of money in the system, it makes no sense to deposit it because the interest rate will be very low. To invest this money in real business is not a bad idea, but at a certain point you may get the question, why do it if there is a lot of free money in the system? But to invest this money in some other financial assets, for example, in shares in the expectation that they will grow and bring income, looks quite promising. Well, if you are a brazen man to the bone, you can use some of the money you receive to start forming a dubious business project, then take it to IPO, then promote it, then invest the rest of the money in your own shares, wait for the FOMO to accelerate quotations 10 or 20 times higher, and sell everything at the very top. In general, the key idea is that during the QE program, bank reserves will necessarily increase. And when bank reserves are at a high level, there is no way to raise the key rate. And that was the main reason why the Fed did not move to tighten monetary policy, even though inflation was out of control. In fact, they started raising the rate when inflation was already at its maximum. And although it seems that after the interest rate increase, inflation began to slow down, you need to understand that due to the effect of a high base, inflation would still slow down even without tightening monetary policy, because it is physically impossible for it to grow by 7% per year every year. In fact, in 2021 and 2022, because bank reserves were so high, the Fed's main fear was that the rate would have to go into negative territory in parallel with inflation. And in order to somehow solve the problem, they came up with an overnight repo. I will put it in very simple words so that everyone can understand it if possible. In general, the Fed invented repo to reduce excess reserves. That is, financial institutions give their money to the Federal Reserve and in return receive a short-term security for one day. For the fact that financial institutions park their money at the Fed, they receive interest, which will be in the neighborhood of the key rate. Now this value is 5.35%. This amount is of course annualized. Financial institutions receive such interest not overnight. Part of the idea was that when reserves are withdrawn, it means that they will become more expensive and therefore banks will lend less, which in today's realities should provoke a slowdown in inflation. So you can see in this graph here that the orange line shows bank reserves. As we found out, when the QE program is going on, bank reserves go up. Here in the form of a blue line appears the balance of the Federal Reserve System, and you can clearly see that in the period from the autumn of the 19th year to the end of the 21st year, the balance and bank reserves were growing. When the balance sheet shrank until the 20th year, bank reserves also shrank. The volume of overnight repo started to grow actively from March 21st. At first, its growth went in parallel with the work of the printing press, so bank reserves were still increasing. But further, it can be seen that when the printing press was suspended and then began to fall, bank reserves decreased even more, because at the time of the suspension of the printing press, overnight volume continued to grow. In a few minutes we'll discuss more about the liquidity impact of overnight repo, but before that, a few words about the Treasury Department. It has funds in its accounts that are periodically spent, which is shown by the drop in this chart, and periodically replenished either through tax revenues or through bond sales. The conventional wisdom is that when Treasury Department funds shrink, it means that money is flowing into the system and therefore it will support the markets. When the Treasury Department moves to borrow, it means that money is being withdrawn and therefore it will be a negative for the market. And there is a third option: when Treasury Department funds are growing due to tax revenues, it is also considered to be generally positive for the market because the money will eventually be spent. But there is a very important caveat to be made here. When such a correlation is made, it does not mean that the funds from the Treasury Department accounts go directly to the stock market. First of all, the main task of the Treasury Department is to distribute the funds to the social environment, that is, to pay teachers' salaries, to maintain schools, to maintain the army, and all that sort of thing. And secondly, when the Treasury Department moves to borrowing by issuing bonds, the word bond suggests that we're talking about the debt market, not the stock market. So it does seem like the effect of Treasury Department funds on the stock market is a theory that's a bit of a stretch. And if you look at the period of the 20th year, you might wonder why, when the Treasury Department was borrowing so much, the market was growing. But when Treasury Department from the 21st to 22nd year spent funds, the market grew even more. But from the end of spring of 22 until June of 23, the funds were also spent, but the market did not renew the historical highs. And that's really true. When we look separately at the Federal Reserve balance sheet, bank reserves, overnight repo, Treasury Department funds, there is always some nonsense. It is banal that even now the balance of the Federal Reserve System is shrinking, while the market continues to grow, although logically it should have fallen long ago. Otherwise, one can ask why so much money was printed that created all this inflation, and yet it turned out that the market can grow without the printing press and somehow the economy has not collapsed yet. So when we talk about market liquidity, which will directly affect the stock market, all these factors have to be taken into account at the same time. I will explain everything in detail and clearly in a minute, but if we talk about the TGA in very simple words to make it clear to everyone, we can imagine the following situation. When the Treasury Department starts borrowing, it does not affect the amount of money, it affects its movement. That is, there was money on bank reserves or on overnight repo, and then it went into bonds that the Treasury Department placed. That money from bank reserves or overnight repo would never have gone into the stock market in its entirety, but it did go into the TGA. The Treasury Department also won't let them into the stock market either, but it will let them into the real economy. Let's say, as a simple example, it allocates $100 billion to buy candy as part of a social project for the hungry. The seller of these sweets has purchased them in advance on credit or in installments from the manufacturer. And so, having received this money naturally with some profit, part of it can go to pay the loan, part to buy new goods, and the rest of the money can be partially invested in the market, for example. Once again, this is just an example for the sake of an example so that it is more or less clear how it all works. And now let's finalize everything. I will show you how to calculate liquidity, how it affects the market, and how to predict its further movement. Of course, the balance sheet of the Federal Reserve System is of paramount importance. When it grows, it means that money is printed and the QE program is going on. When it falls, it means that money is withdrawn from the system or the QT program is going on. And as we know, when money printing is going on, it's very positive for the market. In addition to the Federal Reserve balance sheet, there's the TGA, where within the example above it is considered that when funds are spent it is positive for the market, when funds are replenished it is negative. In general, here's the first trick to understand globally whether the market will be supported or not. When the balance of the Federal Reserve System grows and the Treasury Department borrows money at the same time, it is generally positive for the market because more money will be printed and flow into the market. When the balance sheet is growing and Treasury Department funds are shrinking, it is a mega positive for the market. When the balance stops growing or even starts shrinking and the Treasury Department borrows, it is a negative. When the balance is shrinking but Treasury Department is spending, it is generally neutral but skewed more towards the negative. And in the moment the situation will be determined by what is more. That is, if the Treasury Department gives more than the Fed withdraws, then in general it will be a positive signal. But when we talk about liquidity, which has an impact on the markets, we should not forget to take into account the volume of overnight repo. When Treasury Department does not give money and at the same time liquidity does not come from overnight, on the slide the yellow chart is rising at this moment, the market is actively falling. And vice versa, when charts are falling, it is positive for the market. And there is a third option, when one grows and the other falls, the market situation will be determined by what will happen in the end. If more money comes in than is taken out, the market will support it and vice versa. And it is a component like overnight that gives us a clear picture of what is happening with liquidity at a particular point in time. Now the available liquidity can be calculated very simply as the Federal Reserve balance minus the Treasury Department balance minus the overnight repo volume. If this graph goes up, that means liquidity is flowing in. If the graph goes down, that means liquidity is being withdrawn. And since we know that the market follows liquidity and not vice versa, if we overlay on this chart, for example, the index of small capitalization companies, there is almost 100% correlation. If liquidity falls, the market will also fall. If globally liquidity rises, the market will also rise. But there is one interesting nuance that allows you to earn. Firstly, there is a small time lag, which allows you to predict the future market movement, depending on what is happening now with liquidity. And secondly, since the market is traded by a huge number of participants, it is sometimes subject to euphoria, panic. There are some reactions to the news, which are disconnected from liquidity. But since, as I said, it is the market that ultimately moves after liquidity and not the other way round, the task is to look for these imperfections. For example, when we want to take a long position, we have to find the moment when liquidity is already coming into the market and the market is at the bottom. That means that there is money, but the market is afraid of something. When we are looking for points to fix the position, we should look for those moments when the market will be at highs, which will not be backed by liquidity. So it means that there is too much unfounded optimism in the market, unfounded euphoria, which will eventually deflate. So, understanding the essence of this process in order not to search for discrepancies on these charts, we can divide the index into liquidity, and we will have an indicator with improvised support and resistance levels, which will show us how much the index is overestimated or underestimated in relation to liquidity. It is logical that from the resistance level the probability of downward correction increases, and from the support level we can take long positions. As you know, the market environment is constantly changing. For example, Warren Buffett's method worked well 40 years ago. Of course, it is still relevant now. You really need to invest in strong, reliable companies. But you will never become a second Warren Buffett. Over the last decade and especially over the last few years, the financial system has changed beyond recognition. Market dynamics now depend on the prevailing sentiment and liquidity. So from 2021 onwards, this indicator is one of the key things to look at when making decisions. However, the topic of liquidity does not end there. Today, I told you how Fed liquidity affects the broad market and small caps. But if you look at the S&P 500, since July last year, there is a strong divergence. It seems that the market lives its own life and neither liquidity nor macroeconomic indicators are important for its growth, nor the loud cries of Armageddonists that the economy has been in recession for a long time. I will tell you why this happens and how to predict the movement of SPY and Triple Q in the next video.